Did you know that taking a $20,000 loan from your Empower Retirement 401k could quietly cost you over $50,000 in lost retirement growth? Many people see a 401k loan as a convenient, low-interest way to access cash, a sort of borrowing from yourself. But this seemingly simple transaction carries a complex web of hidden costs and missed opportunities that can profoundly impact your golden years. This isn't just about the interest you pay back. It's about the compounding growth you forfeit, growth that could have been working for you for decades. We're going to break down exactly how this $50,000 figure is reached and why it's a critical consideration for anyone with an Empower Retirement account. But first, let's understand how these loans even work. An Empower Retirement 401k loan allows you to borrow up to 50% of your vested account balance, or $50,000, whichever is less. The money comes directly from your retirement savings, and you repay yourself, typically through payroll deductions, with interest. This interest rate is usually tied to the prime rate plus 1 or 2%, and it goes back into your own 401k account. While that sounds appealing, you're paying yourself back. The crucial detail is that your money is no longer invested in growing during the loan period. It's out of the market. This isn't just theoretical. It has a very real, measurable impact on your future wealth. But the biggest trap lies in what happens if you don't stick to the repayment schedule. Let's put some numbers to that $50,000 potential loss. Imagine you take a $20,000 401k loan. For 5 years, that $20,000 is out of the market. If your 401k typically earns an average of 7% per year, compounded annually, that $20,000 could have grown to roughly $28,005 over those 5 years. That's $8,005 in lost growth. But it doesn't stop there. That $28,005 would have continued compounding for another 20 years until retirement. If you had 25 years until retirement, that $28,005 could have become well over $130,000. So the $20,000 loan, in reality, potentially cost you $110,000 in future wealth. The interest you pay yourself back doesn't fully offset this lost compounding. But there's an even bigger problem, the double taxation. Here's a critical point most people overlook. You repay your 401k loan with after-tax dollars. Then, when you eventually withdraw that money in retirement, it's taxed again as ordinary income. This is the double taxation trap. Consider this. You earn $30,000, pay taxes on it, and then use your after-tax income to repay your $20,000 401k loan. That $20,000 is now back in your account. In retirement, when you withdraw it, it's taxed again. If it had simply stayed invested, only the initial contribution would have been taxed once upon withdrawal for a traditional 401k. This double taxation significantly erodes the overall value of your retirement savings. And this isn't even considering the administrative fees Empower might charge for setting up or maintaining the loan. The single biggest risk with a 401k loan, especially an Empower Retirement one, comes if you leave your job before the loan is fully repaid. Most plans require you to repay the entire outstanding balance by the due date of your federal income tax return for the year in which your employment ended, including extensions, which can be up to October 15th of the following year. If you can't, the unpaid balance is treated as an early withdrawal. This means it becomes immediately taxable income. And if you're under 59 and a half, you'll also face a 10% early withdrawal penalty from the IRS. Imagine needing to find $15,000 or $20,000 to repay a loan within 2 months or face a huge tax bill and penalty. This can turn a temporary financial solution into a devastating financial crisis. But what if the market takes a dive while your money is out? When you take an Empower 401k loan, the money is typically moved out of its investments and into a stable fund or cash equivalent. This means it misses out on any market gains during the loan period. While it also avoids market losses, the long-term historical trend of the stock market is upwards. If you're borrowing for 5 years and the market experiences a strong bull run during that time, you've missed out on significant potential growth. For example, if the S&P 500 averages 10% returns annually over those 5 years, your $20,000 loan could have become over $32,000. That's a $12,000 opportunity cost on top of everything else. It's a gamble, and retirement savings are generally not where you want to gamble. So, what are the legitimate reasons to consider such a loan? Despite the risks, there are extremely rare situations where an Empower 401k loan might be considered, typically as a last resort. These usually involve truly urgent and temporary financial needs where other, more expensive options like high-interest credit cards or predatory personal loans are the only alternatives. For instance, preventing foreclosure on your primary residence, avoiding bankruptcy, or covering critical medical expenses not covered by insurance. Even then, it's vital to have a rock-solid repayment plan and a high degree of job security. It should never be for discretionary spending like vacations, new cars, or home renovations. But even in these urgent cases, there are often better alternatives to explore first. Before even thinking about an Empower 401k loan, explore every other option. Can you build an emergency fund? Even a small one can prevent minor crises from escalating. Consider a low-interest personal loan from a credit union or a home equity line of credit. Heck, if you own a home, though these also come with risks. Can you cut expenses aggressively for a few months? Can you pick up a side hustle? Even borrowing from family, if possible, might be less detrimental than raiding your retirement. The goal is to keep your retirement money invested and compounding for as long as possible. The primary purpose of a 401k is retirement, not a personal bank account. So what are the specific steps to take if you absolutely must consider this? If you find yourself in a situation where an Empower 401k loan seems unavoidable, here's a step-by-step approach. First, contact Empower Retirement directly to understand your plan's specific loan provisions, interest rates, and fees. They can provide exact numbers. Second, calculate the precise repayment schedule and ensure you can comfortably meet it through payroll deductions. Factor in any potential job changes. Third, determine the exact amount you need. Borrow only the absolute minimum. Fourth, understand the opportunity cost. Visualize the future growth you're sacrificing. Finally, develop a clear, written plan to repay the loan as quickly as possible, ideally faster than the standard 5-year term. This proactive approach minimizes the damage, but it doesn't eliminate it. But what's a common myth about these loans? A common myth is that because you're paying the interest to yourself, a 401k loan is essentially free money, or at least cost neutral. This is fundamentally untrue. As we discussed, the interest you pay back, even if it goes into your own account, is paid with after-tax dollars and will be taxed again upon withdrawal. More importantly, the most significant cost is the lost opportunity for your money to grow in the market, tax-deferred. That compounding effect, especially over decades, is far more powerful than the interest payments you make to yourself. Think of it this way. Your money isn't earning market returns while it's out of the market. It's sitting still, missing out on potentially massive growth. This myth leads many people into making a very expensive mistake. Once you've taken an Empower 401k loan, your priority should be aggressive repayment. While most plans allow up to 5 years, aim to pay it back much faster if possible. Increase your payroll deductions beyond the minimum required. Consider making extra payments whenever you have unexpected income, like a bonus or a tax refund. The quicker you repay the loan, the sooner your money can get back into the market and resume compounding. Every month that money is out of the market is a month of lost potential growth. Think of it as an emergency and treat the repayment with the same urgency you would any other debt. This minimizes the long-term damage. But is there any scenario where it's truly a good idea? To be blunt, a 401k loan from Empower Retirement is almost never a good idea in the traditional sense of financial planning. It's typically a least bad option in a dire emergency. The goal of your 401k is to build tax-advantaged wealth for your future, not to act as a personal loan service. Every time you tap into it early, you compromise that future. The $50,000 or more in lost growth we discussed earlier isn't an exaggeration. It's a conservative estimate of the real-world impact. If you're constantly in situations where you feel the need to borrow from your 401k, that's a red flag indicating a deeper issue with your budget or emergency fund, which needs to be addressed immediately. Always exhaust all other options first, every single time. And remember the golden rule of retirement savings. The core takeaway is that an Empower Retirement 401k loan, while seemingly convenient, comes with significant long-term costs in lost growth, double taxation, and potential penalties. Prioritize keeping your retirement savings invested and compounding. If you're now wondering about how to recover lost retirement savings or make up for past mistakes, watch our video on catch-up contributions, boosting your retirement fast next. It offers concrete steps to accelerate your savings. And for more essential U.S. personal finance strategies, don't forget to subscribe.